Hello, everyone, and welcome to Student Housing Unlocked, multi-housing news' podcast series that delves into investments, strategies, operations, and different approaches in the student housing sector. I'm Olivia Bunescu, Senior Associate Editor, and for this episode of our series, I'll discuss with Patrick McBride, co-founder and co-CEO of Coastal Ridge, where he oversees the firm's investment management division and serves on both the board of directors and investment committee. With over 20 years of experience in private equity and real estate, he has played a pivotal role in growing Coastal Ridge to $5.1 billion in assets under management. Interest in student housing is still as high as ever, despite common challenges in the multifamily market. More investors are entering or consolidating their position in the sector, placing greater emphasis on diversified strategies, localized growth, and operational excellence to ensure both performance and resident satisfaction. Thank you very much for accepting my invitation to Student Housing Unlocked, the podcast series that discusses everything student housing. Today, we'll talk a bit about investor appetite in the sector. And I know that the company, Coastal Ridge, has a quite unique backstory, as it began with three college roommates who wanted to invest in the student housing community together. Could you please touch on what sparked the idea and what convinced you to invest in student housing?
Yeah, really the backstory of Coastal Ridge is myself and my two founding partners were housemates in college. We all went off after school and had our own unique work experiences. I spent a handful of years in private equity. My partners started as your quintessential local real estate investors and operators in Columbus, Ohio, around Ohio State University back in 2008. And they cut their teeth learning to invest and operate what you could argue is some of the most difficult student housing, scattered site assets around the campus. So think single family homes, duplexes, fourplexes, oftentimes properties that weren't necessarily targeting students, and they converted them and leased them by the bed and created a lot of value for themselves and their investors. So when we came together in 2013, it was really more of an informal venture between three entrepreneurial friends who wanted to invest in real estate together. There was no ambition to build a large platform, but we saw student as a white space opportunity. It was very early stages of being institutionalized, and we thought we could have success there. So we went out with that business plan to a handful of family offices, and we're fortunate that we found two that believed in us as entrepreneurs and believed in the vision we were pursuing, and ultimately backed us with what ended up being about $400 million of equity from 13 through 2017, 2018. And that allowed us to build that initial billion and a half dollar portfolio. But I think what attracted us to student housing at the time was it was early days. Purpose-built student housing was just emerging as an asset class. I don't even know if it was considered its own asset class in 2013. So we saw an opportunity to get in early on something we anticipated was going to see a lot of growth.
And it seemed like it was a good idea since student housing is now taking over the market.
Yeah, the asset class over the past decade has performed phenomenally well. And right now, the last 2 or 3 years, it's really shined and outperformed just about any other real estate asset class.
Yeah. Could you discuss some of the challenges that you faced while transitioning from that first deal to a nationally scaled operation?
Yeah, there's no shortage of challenges, right? Anytime you're building a business, particularly one as complex as both an investment management business integrated with a property management business, you're gonna face challenges. You're gonna make your fair share of mistakes and have to learn from those and adjust and adapt. I mean, there's plenty of examples. I think maybe trying to create two buckets of challenges we face on the investment front versus the operational front. On the investment front, one of the mistakes I think we made early on, we were a startup and we didn't have a deep bench, and we thought that it made more sense to outsource property due diligence, both the asset due diligence as well as the operational due diligence, to more established, larger vendors. And I think what we learned after the first handful of deals outsourcing that diligence is nobody cares like you care. And things that were overlooked that should have been flagged that we then had to deal with as the owner of the asset post-closing, and we're oftentimes surprised by, that list was too long. And it was clear to us that we could do a better job, and we shifted the model fairly quickly. Operationally, I think the biggest learning was how critical the property management transition was and how critical was that transition be as smooth and efficient as possible. A lot of pre-planning needed to go into it. We needed to have properties that would be fully staffed day one, because in the handful of situations early on where we didn't have that all in place, it can take you months, maybe even years to recover from the loss in potential occupancy or leasing momentum, to restaff a property, maintenance work orders. And when we buy a property today, the upfront planning for a smooth transition is intense, and it needs to be, to ensure that the transition is as flawless as possible.
And how has your approach to risk and opportunity evolved as you expanded your company in over 50 US markets?
I think we're I think we're smarter through reps, through experience. And so quite honestly, I think we're less tolerant of risk. I think if you looked at some of the investments we made early on, maybe unintentionally, we took on more risk than we would take on today. I'd go back and say the first 5, 6 deals we did in those early couple of years, I don't know that we'd do again. And fortunately, most of those deals worked out, but I think we'd look at them today and just say that the risk return profile isn't as interesting as it needs to be to get us off the sidelines.
I'd like to discuss a bit about the student housing fundamentals. Over the past few years, the sector has been outperforming other asset types. What demand trends are you seeing across tier one and tier two markets right now?
Yeah, I think, where we're focused, most institutional investors are focused, is really tier one markets, maybe tier one plus. It's the 60-ish or so top markets, large state public schools. And I think that's where students are focused right now as well. It's both student demand as well as investor demand focused on these tier one assets. I think the students are gravitating towards these markets for a handful of reasons. And you're definitely seeing it in the enrollment growth at the largest state schools. But a lot of it comes down to simply ROI and education. The large state funded schools provide the best ROI. I think it also comes down to the overall student experience, large sports programs, big enrollment, big diverse enrollment for that matter, broad course offerings, overall high quality education for a good value. And then on the investor front, investors are most interested in these tier one markets because of the enrollment growth, right? The student demand and the fact that demand continues to grow. And so there's definitely a case of kind of haves and have nots when it comes to the 2,300 4-year colleges and universities in the United States. There's maybe 75 to 100 that are seeing really strong, stable, and continued enrollment growth. And there's the others. So I think it's both where the students and the investors are going to focus.
And although the sector has been hotter than other conventional multifamily assets, our in-house data from Yardi Matrix shows that it's starting to cool down, with rent growth marking its largest decrease in the past 6 years. What are some factors playing into this cutback, and how is it reflected across your portfolio? If it is, how exactly is it reflected?
Yeah, I think this is exactly how we expected it to play out, right? We saw the same thing in conventional multifamily a few years, tons of rent growth, second half of 2020, 21, 22, and then it fell off, right? It wasn't sustainable. We'll see that trend in student. We always expected it. There were certain markets in the last couple of years that were extreme outperformers, both in pre-leasing and rent growth. As those markets come back down to more normal levels, it's understandable that some of those markets may fall behind year over year. In our portfolio, Coastal Ridge, year over year pre-leasing today is at the same levels we saw it at last year. So we haven't seen a negative trend in pre-leasing. What we are seeing though is obviously rent growth has moderated. We experienced 2 years, two back-to-back years of double-digit rent growth. I think we averaged close to 13% 2 years in a row. That's obviously not sustainable. And if we land somewhere in the mid-single digits this year, we're going to be really happy with that. And I would tell you that's in line with what we would expect.
Mm-hmm. And construction has also been down, and since some of the fundamentals are shaking right now, you've still managed to grow your portfolio by 35% in the past 2 years. Where exactly did you find opportunities in the sector, and how did you decide which market to enter or to exit?
Yeah, I think we would argue that the fundamentals of student housing are still really strong. To the point I just made, yeah, we're coming off a couple of years of really aggressive rent growth. We're moderating though to a stable and healthy place. You can't look at the unprecedented performance of the last 2 years and say fundamentals are now shaky. Regarding opportunities, we're most focused on markets where the supply demand fundamentals are strong and ideally that where they're strengthening or have the potential to strengthen. So that's to say we invest in markets where we feel there's a shortfall of housing, where demand will outstrip supply, and that gives us a chance of continuing to achieve outsized rent growth. In terms of when we exit a market, I don't know that supply demand and that relationship is necessarily what drives the decision. It can defensively, obviously, if we think that there's an imbalance that's going to negatively impact our future performance. Generally, though, we look at the business plan we underwrote. Have we completed it? Have we created value for us and our investors? And if so, time to return that capital to our investors.
And what are your current thoughts on investor appetite in student housing? Are there emerging student housing hotspots that you believe are overlooked or underbuilt?
I would say there's a great deal of investor interest in student housing right now. We are also a multifamily investor and operator. And so we're kind of always out in the market talking to our LPs and JV partners about our various strategies. And probably above all of them, student housing is rising to the top of the pack and has been for the last year or two. Again, pointing back to the performance that the sector has seen. In terms of emerging student housing hotspots,
Maybe some markets that you're more interested in than others that caught your interest?
yeah, I think it changes every year, right? And it really is supply demand imbalance where we see opportunity, what the supply pipeline looks like from new developers coming in. It's not really static.
Do you have any upcoming projects that you're particularly excited about?
We are under contract right now on a large value add student housing deal. So I would tell you our sweet spot is in the kind of 10 to 20-year-old student housing asset that needs a buff and shine. It needs $10,000, $15,000 a unit, new fixtures, finishes, upgrades to common area amenities. That's probably 80% of the student housing we buy is in this value add strategy. And that's where we continue to see opportunity. And the beautiful thing is, as much as there continues to be new development coming to these markets, and any new development by definition ends up being the bright, shiny object, they're highly amenitized. Our value add strategy doesn't have to compete against that. If anything, we want to be, even post value add execution, our business plan is to be priced below those newest assets. And so there's a sustainability to that, right? Because there's always aging assets in every market.
I'd like to discuss a bit about your investment strategies and how exactly did you diversify your investment strategies in the past year. If you could walk us through the structure of those capital vehicles and why they suit your company.
Yeah, I think the reality is we haven't really changed our investment strategy since our early days. We've, of course, refined it based on what we've learned along the way. But as I said, 80% of what we buy is value add. We believe in the ability to create value for our investors with that strategy. We believe it's defensible too, not having to be highest in the market rents. I wouldn't say we're diversifying our investment strategy. And the other question was structure the capital vehicles and why they suit our companies. We raise capital through a combination of joint ventures with other institutional real estate investors and through funds with traditional LPGP structures.
I'd like to move a bit into your management strategy. And I know that hospitality-driven approaches have been on the rise for student housing. Since you're also active in the conventional multifamily sector, how does your resident experience model look like, and how is it different from conventional multifamily or even BTR, since you're also active in the BTR sector?
Yeah, I think the evolution of kind of layering hospitality, a hospitality experience into all housing for top tier property managers is a growing trend. And so what I would tell you is I hope that it doesn't look different from one of our asset types to the other, student versus conventional. I hope we're delivering that same level of service to all of our residents, regardless whether they're students in a student housing assets or a more conventional renter. But it's definitely something that there's been a lot more emphasis on, both us and our peers over the past 5, 6 years, realizing that's what's going to give you a competitive advantage, both in leasing, but also probably more importantly, in resident retention.
And what shifts have you seen in what students expect from student housing today versus a decade ago? Are amenities still a key differentiator, or is there a new focus?
There's no question amenities are still really important, particularly at the top end of the market. It's an amenities arms race. I think with rental rates having risen as aggressively as they have in a lot of markets over the past few years, there's clearly an affordability issue, right? And so I think we're getting to a point where there are many students that would prefer a quality, affordable offering versus the most highly amenitized offering in the market that's top of market pricing. And that's really where we're more focused with our strategies, which is a high quality B plus, A minus asset. We've upgraded units, we've upgraded common areas and amenities, but we haven't upgraded them to the point where we have to charge top of market rents.
We have two more questions left. What KPIs or resident satisfaction matrix do you track most closely, and how do those influence your management approach, if you do?
Yeah, I think there's probably a couple that I personally pay a lot of attention to. One is our resident retention rate. Generally in student housing, I think the view is you want a 40% plus resident retention rate. Keep in mind you're releasing the entire property every year, unlike conventional multifamily where your entire rental isn't turning over at once. Our portfolio has averaged 41, 42% resident retention over the past couple of years. So we're really happy with that. I think the other metric or KPI, I guess, not so much a metric that we pay a lot of attention to are online reviews. What are our residents saying about their experience in our properties?
And lastly, how do you predict the sector will evolve in the next quarters? And is there anything particular industry players should keep an eye on going forward?
I think the common theme that I can bring up here is affordability. There's a lot of new development coming in a lot of markets. Any new development, though, has by definition ends up being top of market rents, and not everybody can afford those.
All right. Is there anything you'd like to add?
This has been great. I appreciate your time.
Thank you very much for accepting my invitation to Student Housing Unlocked, and I wish you the best of luck.
Thanks, Olivia. Appreciate that.
Thank you for listening to Student Housing Unlocked. Make sure to tune in for the next episode of our series. For more news, trend stories, and podcast episodes, visit multihousingnews.com. Moreover, don't hesitate to join MHN's Executive Council. Every month, we discuss the latest trends and topics with leading experts in the field, and your input could be extremely helpful. To join, please send an email to jessica.fiur@cpe-mhn.com. Have a great day, and we can't wait to see you on our next episode.